Okay, forgive me. I didn't unmute myself. It seems to be an issue every week. All right, I'm going to start over again. Let's go back to the other chart. I apologize about that. I like to keep myself on mute till I actually get started. Okay, so let's start over again. I'm going to stop recording for a minute and then start recording. No, I can't do that either. I'm just going to have to see if I can edit this out. Okay. So, and thank you for letting me know there was no sound. A couple of housekeeping things I want to go over first before we get into tonight's chapter. And that is, the first thing is I'm noticing that a lot of folks are not doing so well on the quiz, but they only do the first attempt on the quiz. So I want to remind everybody, you get 2 attempts at the quiz. And as I've pointed out, in a live session and also in an email I sent out when this class first began, that if you don't do well on the quiz the first time, email me and I would be more than happy to point out to you what you got wrong, and you can go in on the second attempt and increase your score. So that's the first thing. Really have the only ones that have taken advantage of this are the ones in my face-to-face class that I teach on Thursday nights. I haven't had anybody that I'm aware of take advantage of this in the internet classes. Second thing is I put out an announcement at the beginning of the semester explaining that this messaging system in Blackboard is new, has a lot of flaws. Okay. The flaws basically, well, here's a good example. On about 50% of the times you send me a message through there, I get a notification in my email. The other 50% that I get don't. And I have to, well, I check the messages in Blackboard every day anyway, but if I get a notification, you might have to wait 24 hours before I get back to you, because if you email me through the message system at 8 o'clock in the morning on a Wednesday, I'm not going to see it till 8 o'clock Thursday morning. So it's really important that you use the email address to contact me that is in the instructor information. Copy and paste it into your Gmail account and send it to me that way. Another problem I'm having, I ran into it this afternoon when I'm trying to track a conversation that I've had through about 8 emails with someone, is the emails don't come up once I answer them in the message section. So if I think of something after the fact I want to share with you, I can't find the original email that you sent me if it's in the message section of Blackboard. Okay. So that's important. So those are the things that I want to emphasize. Make sure you read the announcements. Okay. This new Blackboard is new to all of us, and there are glitches that are making themselves known every day. I have a student that's currently locked out of Blackboard and nobody can figure out why. We had to do a workaround to McGraw-Hill Connect to get them to do that. So that's something that it's something we can do if anybody has that situation, and you should notify me immediately if you do. The other thing I want to make sure you know too is if you have a problem with Blackboard, the support is through the college, so you have to go through me on that. But if you're having a problem with Connect, there's a help number I put in on one of the early announcements that tell you how to contact the helpline for Connect, and McGraw-Hill is pretty good about answering the phones. They have extended hours, and so they can be there for you to help you get around any problems that you're having with Connect. If you miss due dates because of an illness or something like that, that has to go through me. McGraw-Hill won't help you with that, and I can work with you on that. But if you're for some reason getting kicked off in the middle of a quiz or something of that nature, your fastest solution is McGraw-Hill. All right. So this week we are going to be talking about adjustments. We're going to be talking about the different accounting periods, and how basically we're going to close out the books. We're going to, there's a process to closing out the books so that we can produce a balance sheet that's good to go into the next year, and we can reset to zero everything that's in the income statement so we can start the next accounting period fresh. So as you can see here, we have 4 different types of financial reports that are produced. We have quarterly reports, monthly, semi-annual, and annual. The monthly are mainly created to help managers to manage their different operating divisions and that sort of thing internally. And quarterly is mainly for the benefit of the SEC and other governmental agencies that need quarterly reports. Semi-annual, I haven't really seen that much. And then we have annual, and companies will report annually to their shareholders. Occasionally, you'll see companies reporting quarterly to their shareholders, and you'll hear about the quarterly earnings in the news a lot if you follow the business news. But annually is probably the one thing we're going to have the most exposure to, because when we talk about adjustments, mainly we're closing out the end of the year and getting ready for the next year. Now, when it comes to accrual basis and cash basis, these are 2 different accounting methods that are used in order to determine how we're going to record revenue and how we're going to record expenses. So the cash basis is what 80% of the businesses use in the United States because they're small businesses. And we call it the checkbook method, where you record your revenue when someone writes you a check, you record your expenses when you spend the money. That's not the way we're going to learn it in this class. We're going to learn the accrual basis, which is what most corporations have to follow. Under the accrual basis, whenever we perform the service, we're going to record the revenue. Whether we get paid or not, we're going to record it when we perform the service. The other thing we're going to do is we're going to record our expenses when we incur them. Okay, so we're not going to, and we'll see how it plays out as far as how you're going to record your expenses if they're prepaid. So let's take, for example, the contractor example, where you're an electrician and you've got a contract to work with the contractor to put electrical into 3 different homes over 3 different months. Contract says you're going to be paid $30,000, $10,000 per home, and you know that you're going to be spending $5,000 in electrical components in each home. So you go to Home Depot on September 1st and buy $15,000 of materials, and on September 30th, you complete your first home. You're going to record $10,000 in revenue. You're going to record $5,000 in expenses. You're not going to record the expenses when you go to Home Depot and spend $15,000, because we're under the accrual basis. We are going to record the revenue for that first home, $10,000, but that's going to get recorded after the work is done. So that's important to keep in mind. And you might not get paid till February, but we still got to record the revenue and expenses anyway, even though we haven't been paid for the job. So in this example of the accrual basis, let's say on December 1st, we went and paid $2,400 for 24 months of insurance coverage. Now, we can't capture that all at once under the accrual method. We're going to have to spread this out over 24 months. So at the end of the year, on the accrual basis, we're going to have to recognize the $100 of insurance expense. And then in 2022, we'll capture the other $1,200 for that year. And then finally in 2023, we're going to capture $1,100. So we're going to spread this out over time. Now, on December 1st, Fast Forward pays $2,400 in cash for a 24-month insurance policy. Okay, so that's going to be a debit to prepaid insurance, and that's going to be a credit to cash. And that's how it's going to get recorded on the books. Why is prepaid insurance debited? Well, it's an asset. Okay, that's our money until it expires for a particular period of time, and it's going to expire at the end of 2021 for 1 month or $100. So when we recognize revenue, it's going to be recorded when the goods are provided or when we provide the service to the customer. Okay. We're going to recognize the expense when it's actually used to produce the revenue. It's the best way to look at it. Now, as I mentioned in the beginning, we're going to be talking about adjustments and making adjusting entries. Okay. So as you can see, there's 4 types of adjustments. There's deferral of expense, deferral of revenue, accrued expense, and accrued revenue. So this means these things are going to occur over more than one accounting period. And that's why we make entries for them. So as you can see, it's a 3-step process. We determine the current account balance, what the current account balance equals. We determine what the current account balance should equal. And then we record the adjusted entry in the general journal and then post it to the ledgers. So our first example, well, actually, no, we're not into the first example yet, but this explains to you the process that goes on. So when we're doing prepaid expenses, like rent, like insurance and supplies, which we're going to look at. When we go to make the adjustment, we're going to have to credit the asset and we're going to have to debit the expense. That's going to be our journal entry. So going back to our insurance example, we use up $100 worth of insurance at the end of the year for that last month of the year. So we're going to debit insurance expense $100 and we're going to credit prepaid insurance, which will reduce the balance that we have to work down over the course of 24 months. And by the way, feel free to stop me if you have any questions that I'm going over. If you want me to go back and recover anything, just take yourself off mute. If that doesn't work, I'll kind of keep an eye peeled towards the chat box, although it's not currently present. So let's look at prepaid insurance. We've already talked about the fact that $2,400 was spent to buy the policy, and it began on December 1st. So on December 31st, when we go to make our adjustment entries, and by the way, we're going to be making all of our adjustment entries on December 31st. Okay, that's the end of most companies' accounting years, although there are some that will have a fiscal year which will end on June 30th or September 30th. Federal government ends theirs on September 30th. But whatever the end of the accounting period is when we make these adjustments on that last day. So again, we have $100 that we have to capture. So we're going to debit. We're going to debit insurance expense. I'm going to give you the debits first because that's what goes on the general journal first. So we're going to debit insurance expense, $100, and then we're going to credit prepaid insurance, $100. So you can see what the adjustments are and how they've been made. And now if we look at the T account for prepaid insurance, it's now $2,300. And that's what we're going to carry into the next year. Here's your journal entry showing insurance expense debited $100 and prepaid insurance is credited $100. Now we're going to do supplies. In our example, Fast Forward purchased $9,720 of supplies in December. Some of these supplies were used during December. So a physical count on December 31st shows that we only have unused supplies of $8,670. So that's a difference of $1,050. That's the supplies we used in December. We're going to take our beginning balance, subtract our ending balance, and that gives us our adjustment, or the amount that we used when we close out the books on December 31st. So you can see we have a debit to supply expense, $1,050. We have a credit on supplies of $1,050. And that shows the amount that we've used up. In our example here, it says that it's 1 month has expired. So apparently they're doing this every month. Okay. Something I want to say about supplies. Supplies is kind of like an inventoriable item. If any of you have ever had to do inventory, you're going to record all the purchases. You're going to have a beginning balance. So you're going to take your purchases, add them to your beginning balance, subtract out your ending inventory, which in our case was $8,670. And that's how we're going to determine what the adjustment is. Our next adjustment is depreciation. We're really going to take a deep dive into this in a few chapters. But for the time being, we're keeping it kind of simple. We're only going to discuss one method, and the one method is straight line depreciation. If we go and buy a $4 million plant or a $4 million office building, we cannot write that off in the year we bought it. Okay. We have to spread it out over its useful life. Now, fortunately, if we're not sure what the useful life is, the IRS will be quick to tell us. And so a lot of companies will use the IRS standards, which in the case of a building is 39 years. So we're going to have to, we call it expense that asset over 39 years. And straight line is where we basically take the asset cost less the salvage value and divide it by its useful life. And that tells us how much we're going to depreciate every year. And that becomes an expense. So in our example, fast forward purchase equipment for $26,000. Has a useful life of 5 years. And at the end of 5 years, we think it'll be worth $8,000. They purchased the equipment on December 1st, but it is now December 31st. Okay. So you got a couple things going on here. All right. We purchased this in the middle of the year. So if it's straight line depreciation, we're going to have to figure out what our monthly depreciation is on this, because we're only going to write off 1 month of depreciation in this year. Okay. So fast forward, we're only going to depreciate $18,000. We're going to subtract the $8,000 salvage value from the $26,000 purchase price and divide that by 60, which is 5 times 12, 60 months. When we do this, okay, I'm going to skip ahead here. When we do this, we're going to find out that our monthly depreciation is $300. Now, next year, we're not going to do monthly because we're going to experience the full year. And so we'll multiply, this will be $3,600 next year that we're going to depreciate. But we only have 1 month in the year that we bought it. So our depreciation expense is going to be $300. And if we look at the T accounts, you can see where we posted the purchase of the equipment on 12/1 for $26,000. Then we're going to capture the depreciation expense, which is a debit. All right, remember, all expenses are debits, of $300. And then we have a new account, accumulated depreciation. And that's where we're going to put our credit. We are not going to credit equipment. When we do depreciation, we have an adjunct, well, it's actually a contra account called accumulated depreciation. And that's where we're going to put the credit. So why is that important? Well, we got to keep track of all the depreciation we do on this piece of equipment in case we sell it early or dispose of it early or dispose of it for a different salvage value. Because if we go to sell an asset before it's been fully depreciated and we have a gain, we have to record that. So what if with a salvage value of $8,000, what if we sell it for say $9,000? Well, then we have $1,000 gain. And we have to be able to, the only way we can keep track of what our accumulated depreciation is by putting it into this contra account. And as we can see, you can see the 3T accounts, and you can see the journal entry. Journal entry is a debit to depreciation expense and a credit to accumulated depreciation equipment. Now just stop and think about something for a minute. Think about the BMW plant and all the equipment and machinery we have in there. Each of those has a different depreciation life, and each of those has to be tracked individually. All I can say is a good thing we have computers to do that. On the balance sheet, this is how it looks. You're going to have, let's see, on February 28th, after 3 months of depreciation, I wish they would have shown end of year. But if we did a balance sheet at the end of the year, at the end of February, this is what it would look like. You'd have equipment listed for the full purchase price, $26,000, and then less accumulated depreciation of $900. And that gives us a book value of $25,100. And that's what will show up on the balance sheet. Some balance sheets show the accumulated depreciation, some don't. Some will just show you the net value, which is the right-hand example. When we defer revenue, unearned revenue, when we defer this, we're going to have to debit, let's see, we're going to debit a liability and we're going to credit revenue. This is when it's earned. Okay. So in our example, we're receiving cash in advance of providing products or services. When that happens, as we saw in the last chapter, we're going to debit cash for what they paid. I'm sorry. Oh yeah, we're going to debit cash, and then we're going to credit unearned revenue. So when we make the adjusted entry, we have to kind of do the opposite. We're going to have to debit the liability, and then we're going to credit revenue. So let's take an example of, let's say XM Radio calls and you decide to subscribe to 24 months of XM Radio. And you do so on December 1st. So XM Radio on December 1st is going to debit cash and credit unearned revenue for the contract you just agreed to and paid for. Then on December 31st, they're going to debit unearned revenue $100, which is 1 month of service. And then they're going to credit revenue $100, which is 1 month of service. They're not going to do the entire 2 years that you agreed to and paid for. Okay. They're only going to capture the amount of the period of time that you actually experienced. So let's look at an example. Fast Forward paid a 60-day fee in advance, covering the period from 12/27 to 2/24. You can see what the journal entry was. Debit to cash, $3,000. And credit unearned consulting revenue for $3,000. Step 2, Fast Forward earns a payment as time passes. So on 12/31, they provided 5 days of service. 5 divided by 60 times 3,000 is $250. So you're going to have an adjusted entry, all right, where you are going to debit under in revenue $250, and you're going to credit consulting revenue of $250. This is what it looks like in the T accounts. All right. You'll see the additional entries in the consulting revenue. Those are from the prior entries we looked at in chapter 2. Okay, I'm going to go on to accrued expenses now. All right. So let's say you have accrued expenses, and the example that we looked at was prepaid rent and prepaid insurance. All right. So you're going to have to debit the expense, and you're going to credit the liability. All right. Fast forward pays it's, and we'll see this, how this plays out in a minute. Crediting the liability. I just realized something new for you. The example that's typical here is anything that's a payable. And so we're going to look at salaries payable. Fast forward pays its employees $70 per day or $350 for a 5-day work week. Salaries are paid every 2 weeks on Friday. On 12/30, the last day of the year, 12/31 is a Wednesday. So 3-day salaries are owed at the end of the year, but won't be paid until later. So we're going to have to record them. And so we're going to multiply $70 times 3. That's equals $210. And so we're going to debit salary expense $210 because, again, you know, we have these rules that we have to go by. We have to record the expense when they're actually incurred. And so salary expense is a debit of $210. And then we're going to credit salaries payable $210, which is a new account. So that's parking that $210 somewhere until we actually write the check to the employee. Because technically that money is owed the day they earned it. And that's why that money has to be parked there in that account. So you can see here what the T accounts look like for salaries payable and salaries expense. And so this is essentially what we're doing is we're capturing the expense for the income statement this year, but we're carrying it over into next year when we're actually going to write the check to the employee. And we do that through the balance sheet. If you recall, last week I mentioned that the balance sheet is our permanent accounts, all right, that have to be, that we need the balances to go over from one period to the next. The income statement is going to be closed out to zero, and we're going to learn how to do that tonight. So accrued expenses at the end of one period result in a cash payment in a future period. Fast forward, record accrued salaries of $210. Then on January 9th, when we actually pay them, all right, this is how the journal entry is going to look. You're going to see that we're going to debit salaries payable, which removes the liability. Then we're going to debit salaries expense. That's for the amount of salary that was earned in the new year and paid on January 9th. And then we're going to debit cash $700. It's important you grasp this because it's going to get a bit more complicated when we talk about liabilities, and we're going to see, we're going to have like multiple entries here because of withholding from the employee. So try to wrap your arms around this now. For accrued revenue, okay, the adjusting entry is going, we're going to debit the asset and then we're going to credit revenue. All right. Now let's go right into the example. It's the best way to see it. So fast forward agreed to pay $2,700 on January the 10th for future services over the next 30-day period. Okay. Now, this, by the way, is not a transaction. This is a good example. It's not a transaction. It's just an agreement. Okay, we're not going to make any journal entries on this. It's like signing a contract. We're contracting with this person. It's going to pay us $2,700 for 30 days of service. Now, when we perform the service, that's when we have a transaction. So on 12/31, we've provided 20 days worth of services, and that earned us $1,800. So what we have to do, we have two accounts this is going to impact. First, we didn't get any cash. So when we perform a service and we don't get any cash, we put it under accounts receivable. And so we're going to debit accounts receivable $1,800, and we're going to credit consulting revenue, because remember, we performed the service, so we have to capture as revenue. We're going to credit consulting revenue $1,800. Now, there was something, I lost my train of thought when I was finishing the journal entry, so maybe it'll come back to me in the next slide. This is what the T accounts look like. You'll see that we have an adjusting entry into accounts receivable for $1,800. Why are we calling this an adjusting entry? Because we have to close everything out at the end of the year and carry these numbers over into next year. We can't leave this hanging. And as you can see, we credited consulting revenue $1,800. So in next slide, it says accrued revenue at the end of one period results in a cash receipt in a future period. So remember, the agreement was after 30 days, we're going to get paid $2,700. So again, that's a transaction that has to be recorded in the books. We've already earned $1,800, and that's parked in accounts receivable. So on January the 10th, when they write a check for $2,700, we're going to debit cash $2,700. Then we're going to credit accounts receivable because they no longer owe us some money. And then we're going to credit consulting revenue, which that $900 is for the remainder of the contract. This is a really good exhibit 3.12. I would definitely bookmark it. It'll help you in preparing your journal entries when you're making the adjusting entries at the end of the year. Now we have a new financial report. Now it's not really new. Last week we talked about the unadjusted trial balance, and we called it unadjusted because we didn't have adjustments made yet. But now we do. So there's two extra columns, a debit and a credit column, where we're going to post all the adjustments. If you look at accounts receivable, you'll see that we have the $1,800 that we just adjusted. Under supplies, if you recall, that was $1,050, so we credited that. We credited prepaid insurance $100. Accumulated depreciation was credited $300. By the way, that's the normal balance. I should have mentioned that for accumulated depreciation because it's a contra account, contra to equipment with a normal balance of a debit, if that helps you remember. We just did a problem where we have to carry over $210 of salaries payable and so on. So you can see how all these adjustments are put into this now. And if you should total up both columns, and your debits should equal your credits. If they don't, you made a mistake and you have to go back and look for it. Then in the final column, all right, the final column is the adjusted trial balance. You can see all the balances that are in there after the adjustments have been made. That's important. So you're going to bring these over from the T accounts after you've made all of your adjusted entries. You're not going to sit there and sum the unadjusted trial balance with adjustments and put in the $1,800. No, you're going to go back to the T accounts and pull those balances over now that you've updated your T accounts to all those adjustments. I hope I made that understandable. Okay, so the steps here of preparing the financial statements from the adjusted trial balance. First, you're going to prepare the income statement. Remember, this order is the same we talked about before. Income statement, then statement of retained earnings, then the balance sheet. Why the income statement first? Because that gives you the net profit. Okay. You need it for the statement of retained earnings. You can't do a statement of retained earnings without that net profit. All right. So you finish the income statement, then you do the statement of retained earnings. Then, when you feel that is right, you will then post that onto the balance sheet. And then you can publish your balance sheet as being the final and complete balance sheet for that accounting period. This is exhibit 3.14. Don't see how you're going to be able to read this and how it's being presented. So just refer to that and so that it'll keep you straight. Okay, now we're going to talk about closing entries. What's a closing entry? Well, the income statement is temporary, okay? And the statement of retained earnings needs to be updated in the journals and the ledgers. So we're doing this for the journals and the ledgers. Now, some of these balances will carry over to the balance sheet, but just remember this is being done so that when you pull out that ledger for not cash, I should say, say advertising expense at the beginning of next year, it'll be zero to start. There won't be a balance in there. You got to do this to remove the balances. Okay. So that's the whole purpose of us doing this, is so we can bring the income statement accounts down to zero and we can correct the retained revenue account and update the dividend account. So first we're going to identify the accounts for closing. Well, that's going to be, you know, your dividends. It's going to be your revenue, and it's going to be your expenses. Those are the ones we're going to close out to zero. All right. So how are we going to do that? Well, we're going to create an account for one day called the income summary. Only exists for one day. It comes in with a zero balance at the beginning of the day, and it leaves with a zero balance at the end of the day, because we're going to move the balances from the accounts I just talked about over to the income summary, where we're going to then repost them somewhere else into retained earnings. And in that transition, we're bringing all those accounts down to zero. Here you can find examples of the temporary accounts and permanent accounts. Again, I've already discussed this with you. These temporary accounts will be zero when we start off the new year. The permanent accounts, which are the balance sheet accounts, that will get carried over into next year. So the first thing we're going to do is close out the revenue accounts. Then we're going to close out the expense accounts. Then we close out the income summary to the retained earnings. Now, how do we do that? Well, when you sum, I don't want to say you're going to take revenue and minus expenses, because that's an oversimplification. But because you might not have a profit, you might have a loss. So you sum what's in the income summary when you transfer it over, all right? And you put that in retained earnings, hopefully as additional profit. This is a great, great chart for you to make sure you bookmark. It's going to show, now this is in T account form, all right? But you need to understand that you got to still do the general journal entry first. Then you got to post these to the ledgers, which are your T accounts. All right. And then you'll be able to complete the income summary. So let's take a look at step one, close the income statement credit balances. There's an amount in yellow, okay, which is consulting revenue, and an amount in yellow called rent revenue. And when you total them up, it comes to $8,150. Okay, so that's going to be a credit. Why? because the normal balance of revenue is a credit. So to close them out to zero, we have to debit revenue accounts $8,150. That puts their balance at zero. Okay. And then when we do a debit, we have to have a credit. So we're going to credit income summary $8,150. So we're going to debit whatever shows up in the balance under revenue accounts. And then we're going to credit that on the income summary T account. Next, we're going to take all our expense accounts and total them up, and it comes to $4,365. Okay, so we're going to credit each account by the balance that's in there now. All right, your credit will equal whatever the balance is under depreciation, whatever the balance is under salaries, and so on and so forth. We total them up, that comes to $4,365. So since we credited that all those entries, we have to debit income summary. Now that brings all those expense accounts down to zero to start the next year. Now we go look at the income summary. We look at the income summary, and that is step 3. Okay, we have to close it out. The balance is a credit balance when we sum the 4365 with the 8150. It's a credit balance because it's a profit. If that balance would have been on the other side, the left-hand side, we'd be showing a loss, but it's not. So we have a profit of $3,785. Now we have to close out the income summary. Okay, because that's got to be zero. Remember I said it starts at zero, and by the end of the day, it ends at zero. Well, we have to end it at zero as soon as we close out the revenue accounts and the expense accounts. And so we're going to debit income summary 3785, and we're going to credit retained earnings 3785. Follow the arrows, see where they go. Now we're ready to do the statement of retained earnings. And so you can see under dividends, we have to bring dividends down to zero. So the normal balance of dividends is a debit. We're showing $200. So we're going to credit dividends $200, and we're going to move those over to the retained earnings account. And when you sum the debit of 200 and the credit of 3785, that gives us a balance in that account of 3585. Again, rely on this chart as an example as you're closing them out, because this is probably one of the most confusing things that students have to learn in Accounting 101 is how to close out these accounts. So now we're going to do a post-closing trial balance. So we have the list of permanent accounts and their balances after posting all the entries. And then we're going to have total debits and credits to make sure they're equal. And we're going to make sure all of our temporary accounts, which are the dividend, revenue, and expense, are all at zero. And this is what it looks like, which, by the way, is going to become your balance sheet. Post-closing trial balance is just saying, check this form before you go and publish it and send it to the SEC. And by the way, so you know, you don't have to be a corporation to be worried about a balance sheet. The only taxpayers we don't do balance sheets on are sole proprietors, although some of them we do because they apply for loans and stuff, and we like to have them ready. But if you're a partnership or an S Corp or a C Corp, it's required that you have a balance sheet on your tax return so that the IRS can track where you're at with everything. And again, this is what the entire accounting cycle looks like. Essentially, it's what you're going to have as your term project for the accounting cycle problem. And maybe next week I'll roll you through that to let you see what that's all about. The classified balance sheet takes the balance sheet and breaks it out even more than what we've learned to date. There are current assets and non-current assets. Current assets can be quickly converted to cash. Non-current assets, not so much, okay? It's easier for you to sell your accounts receivable to a bank than it is to sell an office building, okay? So that's what we're talking about. So items expected to come due in less than a year are current assets and current liabilities. Those with operating cycles longer than a year, such as a mortgage, again, plants, land, intangible assets such as patents, copyrights, they're considered non-current when they last longer than when the length of time is longer than a year. Exhibit 3.21 shows you how to break this out. I can't remember if you're going to have any problems where you're going to have to break out current and non-current, but refer to this exhibit when you run into a problem that might ask you to break it down so that you get it right. And one thing I've noticed over the years, I've been teaching this 9 years now, and I've noticed over the years that students do not rely on the examples in their books. And I mean, I don't mind answering questions for you when you run up against that brick wall. Don't get me wrong. However, you've got really good examples in your books that will direct you, will guide you in putting together your financial statements if you have to do it within the problems. Okay. All right, we've talked about what these are. I'm going to skip through real quick, and we're going to go take a deep dive in all those things in future chapters, so I'm not going to go into them today. Your formula for the week is profit margin. It's net income divided by net sales. Again, be careful if this comes up on a quiz question because you'll get more information what you need. Focus on what the formula is, okay? So profit margin essentially shows you how much money you have left to pay your expenses. So as you can see here in our example, they compare Visa and MasterCard, which I think are lousy examples because they really don't sell products. I guess you could argue they provide services, but anyway, it shows the difference in both companies' profit margin. It's the amount of money you have left over, you know, after you have, I'm sorry, I described that wrong. It's basically how much you've made, okay, based on the amount of sales you have coming in. So it's a measurement in order to understand your profitability. If you, let's say you were considering buying stock in Visa or MasterCard, right? Well, if you buy stock in Visa, you're going to be getting a bigger return on your investment if it gets passed on to you. That's another story that we'll cover in chapter 12. But in this particular case, you're buying a company that's making more money per sale, all right, than MasterCard is. 53% over 48%. And if you go back 2 years, it's always been that way. Okay. The track record is there. Now it's tightened up some in the current year. But it still should be a better investment if they do a good job of returning dividends to you. Now, the current ratio is the ability of the company to pay its debt. And we're going to look at a couple different debt ratios this semester. This is one of the more simple ones where you take your current assets divided by your current liabilities. Okay. And this, you know, in this particular one, Costco is a 1, Walmart is a 0.8. What you want this to be is you want it to be a lower number. Lower number is better. Okay. So I'm sorry, higher number is better. I got it back. I was thinking of the last ratio we did in chapter 2. So in this particular case, Walmart, let's see, current liabilities is a 0.8. So In other words, they're going to have a harder time paying off their debt if they went belly up. Okay. That's essentially, what you're looking at there. So the more assets you have, all right, the easier it is for you to pay off your debt. Also, if you see an increase in liabilities, okay, you're going to have a harder time paying them off on the same amount of assets. So that's essentially what you're looking at here, okay, is the ability of a company to be able to pay off. And what are we talking about? We're talking about if you're faced with bankruptcy. I mean, you can apply this to your own personal situation, see what your financial health is. All right. What happens if a company wants to improve this ratio? Well, one of the things it can do is it can sell additional shares of stock, which would increase its assets either in cash or investing that in new stores or new plant and equipment. And that would drive up the current assets, all right, over the current liabilities. Another thing you can do is pay off debt. If your profit can handle it, maybe that year's profit, if you're thinking about what to do with it other than pay your shareholders, might want to pay down some of your debt. That would also improve your current ratio. All right, that's all we caught for chapter 3. Do any of you have any questions? Let me see if I can bring up. There we go. And if you do, take your mic off mute. I'm looking right now to see if anybody's taking their mic off mute, and they don't. So with that, I guess we'll go ahead and conclude tonight's session. I should have the video posted sometime tomorrow. Last time I did this, it took over an hour and a half for the video to render to where I could post it up on YouTube. So if it's not up there tonight, it'll be up there tomorrow. Your phrase that pays, in other words, the one you got to put into the survey if you're going to do that for tonight, is just describe the 4 types of financial reporting periods that we started with in the beginning, which are monthly, quarterly, semi-annual, and annual. And remember some of the guidance I gave about emailing and that sort of thing. My goal is to reply as quickly as possible to you guys. And this new messaging system has just been horrendous to work with to make that happen. It makes me sick when I go into the message board in the morning and there's something that I was not alerted to that I could have answered at my office the prior afternoon. So that's all I have. I wish you all the best on chapter 3. Remember, you have a test coming up that's due on Monday. You don't have to wait till Monday to take it. You can take it before then, and I encourage you to do so. And with that, we'll end tonight's session. Have a good week.